Hi, welcome to the May 2026 edition of Student of the Market. At THG Retirement Solutions, we break down the noise and provide a clear monthly snapshot of the markets so that you can stay informed and focus what matters most to you. Last month, we talked about how headlines can feel overwhelming, but that does not always mean the bigger picture has changed. This month is a good example of that. After a volatile start to the year, April was one of the strongest months for US stocks in decades. So today we'll cover April's rebound, why sell in May and go away is not a plan, what all-time highs really mean, why low consumer sentiment can actually be constructive, and why diversification continues to matter. We'll start with the strength in April. US stocks were up 10.5% in April, which made it the 14th best month for US stocks since 1950. Historically, when the market has had one of its top 15 monthly returns, the next 12 months have averaged positive returns. The takeaway here is simple. Staying disciplined through volatility is often more important than trying to predict the next move. That leads us to sell in May and go away. This is the time of year that we usually hear this phrase. Historically, the May through October period has been weaker than the November through April period. And in midterm election years like this year, that difference has been more noticeable. But the last 10 years, things have looked a little bit more mixed. So while seasonally it's interesting, it should not drive your investment strategy by itself. For us, the better question is not what month is it? The better question is your portfolio aligned with your goals? Are you taking the right amount of risk? Do you have the right mix of growth, income, and downside protection in your portfolio? Another concern investors often have is when the market reaches a new high. It can feel like stocks are expensive when you hear about new highs, that a pullback must be coming. But historically, all-time highs are more common than people think. Since 1986, more than 1/3 of months have had at least one day where the S&P 500 hits a record high. And historically, returns after all-time highs have been very similar to returns after non-record periods. So a new high by itself is not a reason to abandon your investment plan. Markets can continue to make new highs over time because earnings grow, companies adapt, and the economy expands. Record highs feel uncomfortable, but they are a normal part of investing. This is one of the more interesting charts in this presentation. Consumer sentiment fell to very low levels in April. Normally that sounds negative, but historically low consumer sentiment has often been followed by positive stock market returns. That may seem counterintuitive, but markets are forward-looking. When sentiment is already on the negative side, a lot of bad news is priced in. This chart shows a very wide gap in sentiment between political parties, which has also added to the overall negativity. Bond fund flows are outpacing stock fund flows. We're also seeing caution show up in fund flows. In the first quarter, bond funds took in $248 billion, which was $134 billion more than stock funds. Historically, when bond flows have been significantly outpacing stocks, that has led to higher returns in the stock market. Again, this is not a forecast, but it does tell us investors are still positioned cautiously. And when investors are already defensive, markets can sometimes surprise to the upside. The Magnificent Seven have been a major part of the market story over the last several years. In 2023 and 24, they drove the large share of the market's returns. But so far in 2026, leadership has been more mixed. Only 3 of the Mag 7 are outperforming the S&P 500 through April. That is not necessarily a bad thing. Broader market leadership can actually be healthier than a market driven by only a few stocks. This lines up with what we had talked about last month. Broader leadership is beginning to emerge. The bond market is also in a very different place than it was a few years ago. After years of very low interest rates, starting yields are much higher now, and they're much more attractive. This slide shows that over long periods of time, bond returns tend to be closely tied to the starting interest rate. Bonds still have risk. If rates move higher, bonds can still fall in value. But having that higher starting yield provides more income and more cushion when rates were just recently near zero. For retirees, this matters specifically, and bonds can once again play a meaningful role in producing income, reducing volatility, and balancing equity risk. As we wrap up May, the message this month is pretty straightforward. Last month, we talked about not letting headlines drive investment decisions. This month, the market showed why that matters. April delivered a strong rebound, stocks reached new highs, and leadership broadened out. At the same time, investors remain cautious. Consumer sentiment is still low, and money continues to flow heavily into bonds. So the bigger picture is not that everything is perfect. The bigger picture is that discipline, diversification, and having a plan still matter. For many investors, especially those nearing retirement or already retired, the question is not whether the market will be up or down this month or next. The real question is, does my current plan fit for where I'm at today? If you're nearing retirement, already retired, or just want to make sure your portfolio still lines up with your goals and you're comfortable with the risk in your portfolio, we'd be glad to help. Thank you for watching, and we'll talk to you again next month.